Right, even if they're and they're minor dips at this part in the cycle, we're going to look back at this time and be like, oh, we barely saw that dip, right? And when you're in it, you're in it. But when you see it, sort of, 20,000 steps away from the chart, it's a very different thing. I mean, I have in my own portfolio and a portfolio that the amount portfolios that we have for our products at Prinsights, I basically have, and I don't necessarily recommend this specifically, it depends on everybody's risk profile, but I basically have about 60% of my portfolio in commodities.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're going to dig into the intricate world of global finance, precious metals and miners, and the geopolitical currents driving today's markets. I'm beyond excited to introduce Dr. Nomi Prins, founder of Prinsights Global, and my friend. Nomi is a renowned economist, former Wall Street insider, and incisive analysis from her bridges the worlds of high finance, energy, and geopolitics. Nomi, it's a privilege to have you back on Metals and Miners. Welcome to the show.
Thank you so much, Gary. It is always a pleasure, and I value your information, your site, and you as a person.
Oh, thank you so much. Back at you, sister. Okay. All right. So, Nomi, you have spent decades on Wall Street and time with Goldman Sachs and have many more decades experiencing market cycles, understanding the intricacies of the markets and how to ride their trends to generate profits for clients, the investment banks, and yourself. Many who are listening have not had these experiences and are unsure of upcoming moves that they should make and what we're likely to experience in the coming months. What do you hope for those tuning into our conversation today that they're going to walk away with after listening to this discussion?
Thank you for that question, Gary. I always seek to use that experience that you so glowingly outlined from my decades on Wall Street through discussing so many policies related to energy and commodities and critical minerals with governments around the world on a regular basis and with miners. And it's really my goal to have people listening here today and in general reading the work that I do come away with more information, more confidence, more tools to take advantage of what I see right now as the most historic super cycle for commodities, not just in my lifetime, but I think in many lifetimes to come.
Yeah, what a time. It's incredible. I know everybody who's tuning in right now is on the edge of their seat to hear what you have to say. Well, let's start with the stock market. Should investors in the general markets have basically earmuffs on in regards to tariff talk and other economic news, as the Trump administration has been and will be pulling every lever monetarily, fiscally, and regulatory wise in order to ensure that growth outpaces debt, and therefore the markets will just keep going up nominally higher?
Yeah, I think there's two ways to look at policy versus the markets. Of course, we see right now equities at a record high, or depending on the day, close to or reaching new highs. And there's a number of reasons for that. One is the just sheer momentum of the capital that is continuing to invest in them, and certainly of the mega tech stocks, certainly of the Magnificent Seven, but also more increasingly, and what we look at is in things that translate real commodities, real supply into real infrastructure, real energy, real defense, and real economic growth. And the policies, whether they are 100% perfect or not, that have been put forth by the administration related to these, and I don't just mean tariffs. Tariffs are a very small component of trying to sort of right the gap that has grown between supply and demand, between the ability of the U.S. to produce and process and find supply and translate it into physical infrastructure, as well as other policies that are coming into play. And we look at all of those as well. So tariffs are really a sort of the more outward focused component of all of these policies, and not just from the Trump administration, really from the first Trump administration, some of the Biden administration, and so forth. But the U.S. is behind on a lot of these measures. Where the stock
That's an
market is
understatement.
also, and I'm sure we'll get into that, but where the stock market is also rising is on expectations that the Fed will continue what it started in September with its cut of 25 basis points at the next FOMC meeting with another 25 or 50. And we predicted 100 from January would happen this year. I still think that's going to happen to help to sort of close that gap from debt financing, the cost of U.S. debt to the U.S. government of that $37 trillion worth of debt, and how to bring that down. And there's going to be a lot of sort of creative ways that have already been announced by the Treasury Department, as well as ultimately by the Fed, probably not under Powell, but certainly under whoever is Powell in May 2026 when that leadership shifts. And that's why the market is continuing to move and has been moving higher. But important to note that commodities are actually outperforming the overall market.
Understatement also. But I think one of the larger components also that maybe is not being talked about enough is the debasement of the purchasing power, not necessarily of the dollar itself, but the purchasing power. In order to repay the debt, it's a lot easier to repay the debt by debasing the purchasing power.
That's right. And again, massive debt. So if the dollar is weaker, if that coincides with rates going down or other, again, creative ways to buy treasuries, because foreign nations are not buying treasuries not only in the same volume that they used to, but certainly in the same percentage of our overall debt that they used to. For example, the People's Bank of China has more gold on its balance sheet now as a percentage of reserves in terms of growth than it has with treasuries, which it has cut in half basically since 2018. And it's not the only bank doing this. What's happening right now is there's just simply less foreign buying of treasuries. So the U.S. has to come up with other creative ways to do that. And one of them, and that has been a policy of this administration, has been to debase the dollar. And another way to do that, aside from its lack of fiat value versus hard physical assets and physical commodities, is to find ways to continue to push the Fed to reduce rates, push QE, push the purchasing of treasuries by the Treasury Department itself, and other methods to do that. And that's not going to change. We have a lot of debt. We have a lot of burden of debt payments, and we're not even close to passing a budget yet, let alone noticing there has not been a conversation in Congress while all the squabbling is going on about the budget, about the extent of these debt payments that we are not going to be able to get out of.
So I wasn't going to touch on this today, but since you brought up this, I do want to ask this question. So, we have this increasing debt burden. We have this massive maturation that's coming our way, this wall that's going to need to be rolled over. We have less buying in volume and percentage, as you have already outlined. Yet, since mid to late May, we have seen the long-term yield going down instead of going up. What do you make of that?
It has gone down. I mean, that is true, but not really by as much as it would. The yield curve is still steepening relative to the front end of the curve. And so there's these two things going on. And we write about this a lot. It's kind of a conundrum. On the one hand, you have the perceived and announced both policies of the government as to how it's going to deal with purchasing or repurchasing its debt. It wants to roll it over at lower prices, but wanting to and having it happen are two different things. And meanwhile, on the other side of that equation, as we were just talking about, you have foreign buying not coming in at the same capacity that it did in the past. So there's a volatility there. So even though treasuries do come down on the expectation of all these domestic potential movements, the reality is you still are volatile in terms of where that 10-year will be or where the 30-year will be because of what's happening on the outside, which is one of the reasons why we just don't recommend buying U.S. treasuries. We don't want to be in that percentage. Although, again, we can still see yields coming down. We can still see prices going up, but that's artificially crafted as opposed to where we see other value.
So real briefly, though, do you expect it to bottom, the long term to bottom the yields and then to bounce back higher at some point?
I think so, because there's only so much that you can have these interim spurts of anything that looks like QE from the Fed or anything that looks like buying from the Treasury Department, or allowing banks to effectively not count, which was something that's happened from a regulatory perspective. The final vote will come in on January 1st, but not be able to necessarily count treasuries as part of their reserves, which will mean that they won't have to hold them against their reserves, which will mean they can pledge them to the Fed on these 24-hour rotation sort of facility bases, and look like they're buying treasuries when in fact they're just sort of moving them back and forth across this sort of big, chess game of moving treasuries back and forth.
It sounds a little bit like the AI setup that's happening between NVIDIA and a few other players. Okay, so Nomi, let's discuss the electrical grid modernization needs. We've got this AI explosion, the electrification of everything, the coming robotics boom. Yet at the very same time that all of this demand is starting to coalesce, and it's going to be historical demand, all across the country, we're seeing spiking electricity rates. And that is before the massive energy chugging ramp up of these data centers, these massive data centers that are going to start being built all over the country. So the grid desperately needs to be updated. Massive energy sources need to be tied in to support it so that it doesn't further cripple the consumer. I'm not sure. I didn't run any numbers, but from a percentage wise, I think electricity rates were up this summer compared to last summer, maybe as much as 50%.
That's correct. Yeah,
And
we've seen
maybe
that.
higher. Is that
Yeah,
about right?
that is about right, depending on your state, and again, how good your grid is, and how many other sources are coming in. But on average, that is pretty true. And we're going to have winter
Okay.
coming up in next summer.
So with that being the case, and everybody, not everybody, but the majority of the bottom of the K, in terms of this economy, which makes up maybe 70% of the population, these folks, many of them, even folks who are making as much as $250,000 a year, are living paycheck to paycheck. So how, if we see another 50% bump next year, how are we not going to see people taking to the streets protesting here? How do you expect this grid modernization to unfold? Where are we looking to invest?
Yeah, that's also an excellent question, because what we've seen is the Army Corps of Civil Engineers has ranked our energy on a report card basis. They do these 3-year report cards at a D or D plus, and that's primarily because our grid capacity for all the things that you mentioned is so limited, and that's one of the reasons that we continue to see blackouts and brownouts on a regular basis across the country, in particular in areas where that grid is most frayed, or areas where growing AI data centers are sort of taking that capacity from the grid into their own sort of fiefdoms, and therefore people or communities or counties on the outside of that are seeing more disruptions to their electricity. We desperately need an upgrading of the grid. We're not the only country, but focusing on the United States, we have a significant expansion to be done on the grid, and the cost of that will be somewhere from $500 billion to $2 trillion, depending on whether we're just fixing what's already there, to renovating what's already there to a better level, to actually creating additional grid and grid capacity where there's a dearth. And that doesn't count all of the other energy sources that we also need to upgrade and connect into the grid. For example, along the nuclear technology space, where uranium is very much a part of that, and where there's a requirement to do that. Now, U.S. policy is kind of getting this. There had been, in the beginning of this year, one of the major initial executive orders was about how we're in an energy crisis, and a lot of that had to do with the grid, and seeing all of these other demands coming onto the grid. And also, there's this other problem with the grid, in that we, A, need to build more, B, have that cost, and C, we need the supply of commodities and produce commodities to be able to build it. For example, the U.S. produced about 670,000 tons of aluminum last year, right? We consumed 5 million, so more than about 6 times that. We import 50% of it, and aluminum is one of the primary critical minerals, along with copper, that is needed to build these grids. So there's a lot of things going on at the same time. There's the grid, there's what makes the grid, there's finding it, there's producing it, and there's trying to create a domestic ring fence around it so we can control our prices. So that, to your question, People aren't in the streets when their utility prices go up, not just by 50% next year because of all the strained capacity and strained current grid situation, but to 100, 203% over the years to come.
Doesn't everything you just painted that picture, doesn't that really lead to a guaranteed CapEx cycle that we have never seen before in order to ensure that these underlying materials are ultimately not bottlenecked here inside this country so that we can keep progression happening?
No, that's absolutely right. And the idea of not having a bottleneck, and a lot of that happens through China. Depends on the material that you're talking about, because we also need magnetic materials across the grid and to plug in EVs and other AI data center battery storage situations and so forth, much of which is produced in China. 57% of aluminum production, imported production, comes from China. We have a tariff on that aluminum. We had it in 2018. We had it in the beginning of this year. We had it increased in June. And all of that is expensive. And what that means is that the United States has to, and is doing it, but this takes time. You can't just like create a smelter processing plant in 10 minutes. We only actually in the US just like vaguely greenlighted 2 more new ones, of which we only have 4 in the entire country. And again, I'm just focusing on aluminum because it's one of the things we don't talk about a lot. So I throw it in. I've been really focused on it. But all this requires ring fencing, yes, supply, but also production. And so one of the things that the United States has been doing more progressively, more rapidly, is trying to reach across to allied nations, for example, the UK, and to create a sort of joint energy agreement whereby whether it's nuclear, as we just did with the UK earlier last month, or whether it's with rare earths, as we have an agreement through one of our areas with Canada and with Australia on rare earth materials. All of that requires agreements. It requires trade that's more favorable between these nations for these products. And that actually is happening, and it doesn't hit the headlines, which is why there's opportunity in it for investors to watch in terms of grid modernization, but also it takes time. And that's where there will be continued squeezes in the commodities that are required to be a part of these chains.
Well, I'm excited. In about a month, we're going to be talking about this a little bit more in depth. Do you want to share on that?
Yeah, I gotta thank you so much, Gary, actually for organizing what I am so excited about, and I think will be an amazing webinar event. I don't want to just call it a webinar. That's kind of doesn't even do it justice. But the event, really to dig into the grid, the supply chains, the economics, the profit and opportunities available for all of the commodities that are associated, and there are a lot, and the ways in which those opportunities are presenting themselves, whether it's in the raw supply or whether it's throughout the processing supply chain. And I'm thrilled that I'm going to be a part of that on November 12th. I really look forward to learning from the incredible panel that you have put together, Gary, to really dig into this. And honestly, anybody who has invested in literally anything or has an electric bill of any kind should really come to this. I think it's going to be incredibly illuminating, to use an electricity term, but nice. Also very, very profitable and very interesting.
Yeah, and I agree with everything you just said there. And instead of getting taken advantage of by the increasing rates, we have an opportunity to invest and get ahead of that. And so I'm excited to have you. Thank you for joining the panel, the faculty, along with Luke Roman, Larry McDonald, and Kevin Goldstein. It's going to be very exciting. Well, let's. Move on to gold here. Gold is often viewed as a thermometer for the global financial system. Many right now with gold's rise. They're beginning to get nervous. It's been a sharp rise. It could be foretelling some type of crash or significant crisis that's on the way. What do you believe that gold's price rise is telling us?
Gold's price rise is telling us that it's more important to be anchored in real assets than in fiat currencies, whatever the backdrop is behind them. And one of the things that's very interesting about gold's current rise is the momentum has been increasing as more investors, as more sovereign wealth funds, as more family funds, as more governments, as more banking systems are increasingly accessing physical gold supply and also silver to another extent to shore up the other assets that they have in their portfolios, in particular debt assets, which is, again, I don't like them, but there's been this rotation. If you look at the fact that Morgan Stanley really sort of led the pack, and they're not the only ones,
Yeah.
it's going to continue to happen. I think I was mentioning, I don't know if it was on your show a number of months ago, how Morgan Stanley was just trying to start telling its high net worth value investors to really allocate more to gold. And now all of a sudden they're saying, well, 20% of your portfolio should be in gold. Now that we got our high net worth investors in there, let's open it up. This is something that we saw that's going to happen and we'll continue to see. And so what's happening is that's only one aspect of the market on the Western side of the market that's coming into this space. On the other side of this space, you have central bank buying, which has been going on for now record years of intensified buying for their reserves. And that's going to continue. And the fact that we have this little teeny sort of lull in the around $3,400 price per ounce of gold earlier this year. And then once we barrel past those few months, we're seeing banks take out gold, central banks at 3,800, 3,900, and upwards of 4,000 we're going to get to in terms of their purchasing. We've seen 4,000 be hit by gold. That's one of the reasons why we forecast gold to be 4,000 in January and upped our forecast last month to be 4,500 by the end of the year. So I expect Morgan Stanley, Bank of America to follow that because they've been pretty behind us by about 3 to 4 months along the way. But all of this demand for anchoring reserves, for anchoring the financial system outside of the dollar, for anchoring platforms and logistics for payments with having a gold sort of insert into that, because even though we don't have a gold standard officially, by the very fact that you have less holdings of treasuries and more holdings of gold infiltrate basically all of the central banks, certainly the BRICS and their associated countries and their trade alliances along the way, de facto, that means that trade is starting to be underlined by gold. And that's going to only continue as well because it makes it more autonomous from a global monetary perspective for these countries to be holding gold. So you have all of these tailwinds for gold.
So also, commodities have been priced in dollars. Gold is going up. Gold is being used to net settle trades rather than dollars. How much of an impact on the commodity side or on the gold side with it now settling commodity trades? How much of an impact is that?
Well, again, like you mentioned, it is starting to settle these trades, but more so than that, it's behind the currencies in which trade agreements are being penned. So, for example, right now, about 20% of the oil agreements in terms of purchasing oil agreements are not in petrodollars, which used to be in petrodollars, which are now, for example, in ruble one or in different sort of external currencies. Implicitly, those are underlined by gold. So even though there's not an official settlement in transferring gold to gold, there's two other things that basically are part of those equations, where you have about 20% now of trade that used to be in dollars moving over to other currencies that themselves have central banks that have more gold than treasuries, right? So that just very fact means we're moving towards that sort of 20% link
That
from
base rate of
and that will only continue as more gold is available. But what that also means, and what we're also seeing, and the other aspect of that is more gold is being stored in vaults. More vaults are opening, highly technologically advanced vaults around the world that weren't there.
That is true.
To Dubai, to Singapore, to Shanghai, and one of the reasons for that is not just to have the gold, but to take the gold physically out of the market in bulk into very large, again, highly technologically advanced and secure vaults. What that means is more gold will need to come out of the ground. What that means is that the miners who aren't the large miners, who some of whom have had their stock prices sort of double as gold has gone up and sort of moved in tandem, many of the smaller miners have not even seen anything like that upside. But more so, it's hard to create a mine to extract gold. The same thing as silver. It's actually more so the case with silver, and put it out into the atmosphere and put it out into the hands of banks and investors and central banks. And we are just at the beginning of seeing that transformation really kick into gear.
So there was a lot there. And so, when gold broke out in early of 24, we had basically, it was because of the underpinning, basically a floor that was being set by the central banks that had been purchasing for the last, we'll call it 2 years before that. But now you have multiple floors being set. So you have the central banks who are eating up 30% or so of the available supply. Supply is flat. There's no new mines coming on. They're going deeper. The ore grades are going down. It's been flat supply under 3,500 tons, I think, for 25 years now.
Right.
So you have 30% of the available supply is being eaten by central banks. And now you have the other things that you mentioned that are setting additional floors even before the retail buyers come in. So do you expect all of this combined essentially is going to prevent sharp declines in the price? In fact, more than likely, it could lead to a similar situation we're seeing with silver, where there's not enough product to go around.
That's exactly right. I mean, if you just extrapolate from the Morgan Stanley directive towards its investors, and when it says that, it's doing that, right? It's not just giving advice to B20. It's moving. It's moving, right? It gets a fee every single time it sells something and buys something else for any of the funds that it's managing, right? And it's not alone. If you multiply that into ETFs that do have physical gold backing them, and all the different ways that financial mega players like BlackRock and Vanguard and so forth are needing to now access gold into this new reality, that is definitely going to create a floor for gold and push it up. And I think that as we head towards the end of this year, what we're going to see is those allocations come into fruition, right? So these announcements come out sort of a quarter before year end. People, investors, banks look at their portfolios year end, see how things are doing, decide what to move into, what to move out of, and then you start to see these mass movements. So I can see a situation where between the end of December and the end of January, you start to have a real push up in gold as well, in order to sort of be ahead of where prices will then go into 2026. So all of this is really to say that when we do see any form of headlines or dips or whatever in the price of gold, that the actual physical buying and need and demand and reasons for that need and demand for gold aren't going away. And any of those dips are just opportunities, really, whether it's to buy physical coins, physical gold, physical good-backed ETFs. I'm not a big fan of most of them, but the ones that actually do purchase the gold as well, because then you're sort of leveraging both. And miners, again, that actually are permitted or close to production with high-quality, neutral jurisdictions for their mines are definitely the other way to leverage on the back of that gold appreciation.
So essentially, we've been conditioned as a society through Wall Street to buy the dip in the general stock market, but now it looks like it's very clear that we are now in the buy the dip part of the trend for the precious metal cycle.
Right, even if they're minor dips at this part in the cycle, we're going to look back at this time and be like, oh, we barely saw that dip, right? And when you're in it, you're in it. But when you see it sort of, 20,000 steps away from the chart, it's a very different thing. I mean, I have in my own portfolio, and a portfolio that the amount of portfolios that we have for our products at Prinsights, I basically have, and I don't necessarily recommend this specifically, it depends on everybody's risk profile, but I basically have about 60% of my portfolio in commodities. And so some of that is not even about buying the dip. It's about recognizing, again, where these mining companies are coming up, where there's going to be the most of a gap between supply and demand for multiple kinds of commodities, and just positioning through the ups and downs if downs happen, and just not really worrying about it because of this, again, immense super cycle or immense transformation and the awareness and the need of real supply to real demand.
I hope that those who are listening, are understanding what you're saying and are not getting caught up in some of the RSI overextended metrics and a few other things. This is something that is, when you're talking about a monetary regime change, the charting tools typically are not applicable. there. So, all right. So, Nomi, I think you probably heard this today. Scott Bessent, he said, when you're facing a non-market economy like China, you have to exercise industrial policy. So we're going to set price floors and the forward buying to make sure that this doesn't happen again. And we're going to do it across a wide range of industries. Will you break down for our audience what Secretary Bessent is saying here and what the most probable impacts and outcomes of these price floors are going to be?
Right. So there's different ways to look at that. There's price floors, for example. I'll start with rare earths, which is not as common for everybody's awareness as gold and silver and copper and aluminum and even uranium. But I say that because the United States government did something, and Scott Bessent was integral to arranging this deal, that was very, very different in terms of a public sort of private partnership investing in MP Materials, which is a rare earths company in the United States, which produces a very small fraction of the rare earths that are needed to move the Defense Department, whether that's in missiles, whether that's in space technology, whether that's in security technology, national security, and so forth, and energy. And so one of the things it did was it set a floor of $110 for rare earth oxides, compounds of some of the main materials of rare earths, which are basically magnetic. They store energy. They sort of magnetize energy. They work in multiple weather conditions and so forth. And China's price on those were about 60. And so what it does is it moves the floor actually upward. So it basically takes the profit out of China's ability to keep those prices down by saying there's this whole other market here. We're going to take the market away from you. We're going to incentivize people along the supply chain to be engaged in that higher price tier market. And as we do that, we're going to reward our domestic partners along that supply chain. So that's one way where the United States has set a higher floor than what China is doing. And this is what they're going to do in a lot of instances. This is one of the reasons why there's been an extension of aluminum and steel tariffs with regard to imports from China, or just generally with respect to China. And aluminum and steel also have tariffs around the world, but specifically 50% there, is because they want to basically incentivize countries to trade sort of away and processing plants to have more profitability outside of China, and sort of dig into its ability to keep those prices down because of all of the government intervention that it has throughout the supply chain. So these are the things that we've seen happen just this year, and these are the things that are going to happen more and more. It's starting to happen in lithium, where the United States is looking to effectively partner with companies that can process commodities away from China, because China's processes so much of the raw materials, whether they're physically located in or near China or whether they import those materials, process them, and then sell them outwards. So what it's going to look like is prices on these commodities are going to rise for companies in between and for consumers. Your average can of Coke is going to have more of a cost to the aluminum that creates the can than it would before. It might be only a few cents here and there, but those sorts of things are going to come into everyday prices as well as larger prices like the aluminum that's used for the grid. But also those things are opportunities for investments, because what you're doing is you're moving with the might of U.S. policy, and U.S. policy as it connects to working with other countries. Like I mentioned, the UK before, Australia, Brazil is another big component of where that agreements can be made.
How much of an impact across the spectrum then? So, the companies they're setting these price floors, and there's some companies getting investment, but these other companies that are competing with the ones getting the investment, you're seeing the ones with the investment, they're rising sharply. How much of an impact is it having? Is that pulling these other ones up higher as well?
That's a really good question, and it really depends on a couple things for the other ones, as you mentioned. It depends on the relationship of those other ones to the ones that are getting the funding. In other words, if there are agreements where, if, for example, if MP Materials gets an incentive to create more money on their processing facility, it means that other companies that supply it with certain rare earth materials will be able to charge more for their supply because it's going to be processed because the U.S. is backing that processing. So if the companies are positioned along that chain properly, meaning they've got the relationships with each other, they've got solid standing with the governments that are involved, they've got senior executives managing the company that know how to both produce and be cost effective and maintain those relationships. And yes, those ones are going to be pulled along. And on the flip side, the ones that don't have those things or can't figure those things out are either going to be bought up and maybe have like quick bids and then sort of go away, or just not be able to continue to function. And we do see that around the world when there's major jurisdictional changes or permits are impossible to get or whatever it might be. It sometimes forces some of these companies to cease or to sell themselves elsewhere. And some of them do sell to China. I mean, so there is, it doesn't always go into, as a Western policy. It certainly hasn't been. But again, so it's very specific to the material and the mining company that we're talking about along this supply chain. But yes, there are absolutely like massive opportunities if you're watching for all of these parameters to line up, and equally risks if you aren't paying attention to them.
All right, so Nomi, we talked about the miners briefly earlier, but the gold and silver miners, they were historically undervalued about a year ago. They began moving in earnest January 1st of this year. In the second quarter, they reported record earnings and they had big moves. The metals then continued higher since, and energy inputs, they've remained muted on the lower bound range, which is a good proxy for the all-in sustaining costs. And so Q3 earnings reports should actually blow away Q2 records, right? And even since then, average gold and silver prices, they're even higher now. They're significantly higher in Q3 versus Q2. They're now higher to start Q4 than they were in Q3. We haven't even heard yet the earnings for Q3. Despite the move that the miners have already had, they are still at a discount. They're not properly rated yet. And now Q4 is starting better. Why should the miners stop rising right now with this backdrop?
Again, they shouldn't, and it does boil down though, as we were just saying before, to which miners, how they're positioned, and how they are leveraging the prices outside. So that means how much of the physical assets do they have out of ground? How much pledging do they have from the larger companies that are involved in those assets to bring them along from underground to permit to production? Again, it's very interesting in that miner space to watch all these parameters unfold. But if all the parameters line up properly, as they did in Q3 for the right miners, yes, they should continue to see significant outperformance. And in the process, they're able to also, again, as you mentioned, energy costs being at least where they're at, so not rising by as much as commodity prices are rising, which they aren't. So that all those things considered equal, they should have very good Q4s. And again, not just in gold and silver, but throughout so many other commodities in the space, and overlooked commodities, or less talked about, platinum, palladium. Again, aluminum, which is one of my new favorite things to look at because we're not talking about it that much out there. But all these things, silver's an incredible. Silver has a massive opportunity for the right miners, because right now, and we just did this analysis for an issue we just had out. But basically, as you mentioned, there is a lack of supply of silver to meet demand. Silver is used for so many industrial purposes, so much of this AI data center building, so much of the energy transformation. I mean, it's just phenomenal requirements and demands that aren't going away for silver. And the supply gap that already exists can't even meet that demand. And that demand grows your supply. And we did the study where from now until early 2027, we looked across all of the mines that are going to either come in line or be permitted with high quality silver in good jurisdictions. So already tested in jurisdictions that aren't going to, come in and steal it or make it stop or do bad things to the mines. We think, with all the information that we have and exists right now, right? Yeah. We're not completely fortune tellers, but given all that, if all those come online as they are supposed to do by 2027, we will still be at a shortfall of over 150 million ounces a year of silver. That's if demand doesn't increase, and that's if nothing goes wrong, and that's if there isn't more demand coming from investors or silver-backed ETF. So we're looking at years of this supply gap, and particularly down 2027, because after that there might be some mines coming online. We'll watch those, but just looking at over the next year and a half period, that's what we're seeing. There are a couple that are going to come online or be in that almost permanent space. Those are the ones where we see the most opportunity upside because they're going to be first in line to sort of take advantage of adding on to what you were just talking about, Gary. But it's really interesting what is going on, Sylvan. You want to be positioned in some of these right miners and just sort of
Yeah.
hold them.
Yeah. I just want to touch on real briefly a huge difference that we see in the space from the previous couple of massive bull runs in the early 2000s and the 70s. In the 70s, as the bull run progressed, energy began to skyrocket. In the 2000s, energy skyrocketed. But coming into this particular one, it was the administration, specifically Scott Bessent. He had a 3-3-3 strategy. Part of the strategy of one of the threes was to get 3 million barrels of oil onto the market a day extra beyond what we already have in order to prevent inflation from really taking root, because inflation takes root when you have higher oil prices, right? So by keeping this lower, by keeping oil energy lower, you have a much better chance of containing inflation. But that creates an incredible backdrop. And so, they may not be pumping 3 million barrels of oil a day domestically, but what we're seeing over there with OPEC and how they're releasing more barrels each quarter, each month, collectively, we might be hitting those numbers at some point here in the next year or so. So it is foreseeable that we could see low energy costs here for the next several years to come. That is a huge difference compared to where the previous two mining bull runs, precious metals mining bull runs, were. What are your thoughts on that?
It's interesting. I am not a huge proponent, well, fan of the idea of oil prices going up either. I don't see the math working in that way. First because of the policy of the White House, as you mentioned, and also because of the policy of OPEC, as you mentioned. There's a lot of a scramble throughout the world, including in the U.S., to keep energy prices, from the standpoint of oil, not energy prices, but oil related energy prices down, because that is controllable. Our independence from the standpoint of oil means we have sort of an ability to control to some extent what's going on in the market. And OPEC kind of has the same MO right now because they're trying to expand allied relationships outside of the U.S. So they will basically flood the market, if they can, with lower priced oil in order to scoop up market share. So there's a lot of geopolitics that are going on with oil. And to that extent, I do believe that oil prices can be kept down. I think inflation at 2.5%, 3%, whatever it is actually not a big deal. This idea that we were so obsessed with inflation being over 2%, because that's what Powell said, is really something that it's really just come about in the last few years. We've had inflation at 2.5, 2.7, 3 in the past. Not talking about the spikes you're talking about, but in general, it's not been a focus or a big deal. And I see it kind of staying where it is anyway, regardless of where oil prices
Especially
really
with
are.
the debt, especially with the debt load that we have. I mean, they can't afford to risk having oil, spike and then inflation spike, and then us having, tax receipts drop 20% and unemployment skyrocket.
Well, exactly. And here's the critical point on that. There's a big difference between the controllability and the independence on oil and what you can do with oil prices relative to overall, as its own percentage of overall inflation or energy prices, versus all of these other things that we're talking about from the standpoint of the grid and other commodities over which we don't have that kind of control. And so that's why there's this real bifurcation, which is going to go on for years in the energy market, where the government's really focused on both, but one can be done more easily, like controlling the prices, or at least the supply of oil, because we have that independence, but also the world wants to do the same thing, and so that can be a component of lowered prices. On the other hand, we're setting floors much higher than the sort of Chinese-centric market on a lot of commodities. We don't have production capacity for a lot of the materials that we need for the grid or for energy or for AI centers or all the multiple needs going forward. And so that's going to potentially have an increased impact on energy prices. So we're really seeing both sides. The U.S. government, I do think, is trying to do both things. And the last administration did this in a much sort of less intense way. But they're definitely doing that. They're trying to look at oil, and then they're also trying to look at all these other aspects, and which will take much more time to have any sort of remote independence. And that
Yeah.
independence will be based on allies anyway. And we're at the beginning stages of the other commodities and aspects of energy. So we have to look at that situation and the question about oil and what it does to energy on that one side, and on the other side, the grid and the materials and the tariffs and the production, the policies that are going to take longer to really change the nature of the landscape of our control over that set of
Yeah.
commodities
Wow.
and energy.
Yeah, it's a great way of putting it. Well, this has been an incredible discussion. I want to welcome everyone who's tuning into this fantastic interview with Dr. Nomi Prins, founder of Prinsights Global. Before we wrap up here with our final question for Nomi, I want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. I'm also positive that you've been enjoying the conversation we've been having. Please let Nomi know, hit the like and subscribe button, and leave a comment below the video. So, Nomi, normally we would have our asset ranking lightning round right here, but in the interest of time, I think we'll skip that for today. And would you please share a key takeaway that you want viewers to keep in mind about today's economic, market, monetary situation, metals, mining, whatever's on your heart, and then let everybody know where they could learn more about your work and how they can connect with you.
All right, thank you so much. So I truly believe that anyone who is invested in commodities should look to increase that investment as a percentage of your investments over, well, just now and over the next many years, for both generational wealth purposes as well as for upside in the nearer term future. I believe that there are significant opportunities in the price in the hard material as well as the mining sector, in gold, in silver, in copper, in uranium, in rare earths, in aluminum and in platinum and in palladium. Basically, you want to have an array, but start with gold, move to silver, and really try to get very knowledgeable with these assets, because they really do have more upside than your Nvidias and your Teslas and everything else, because those companies, they don't operate without these commodities, and these commodities are at a dearth of supply and production. And so if you want to leverage that entire world of investment, I really encourage you to get familiar with those assets and the mining companies that are associated.
That's wonderful. And how could everybody get a hold of you, find you, connect with you?
Yeah, so the best way is to go to my Substack, which is prinsights.substack.com. We have two products that we look for particular investments along the side of that commodity and miners curve, which you can consider checking out. We also have a lot of complementary material on all of the geopolitical, economic, and commodity-based trends that are happening, and that I see, as you know, Gary, I travel around the world examining what's going on, and we'll continue to do that. So I encourage you to check out what me and the team is doing over at Prinsights.
And you're also on X, right?
I am on X, I'm on LinkedIn, I'm on Instagram, I'm on all the socials as well.
Okay, so I'll have all that information up on the screen. I'll also have it in the description area for everybody to click through. Also, November 12th, you'll be in the faculty panel. Make sure you guys come back and listen to what Nomi has to share. She's going to share some insider secrets as well. Nomi, thank you for coming on to Metals and Miners. As always, you're so generous with your time and analysis and ideas, and I always love spending time with you. Look forward to having you back on sometime soon. Everybody else, thank you for watching.
Thank you.
Before we wrap up here with our final question for Nomi, I want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.